first quarter earnings season is underway after starting on a downbeat note with Alcoa's results. At the same time, investors are still playing the guessing game on when the Fed will start to raise interest rates. Joining me now is Nicholas Colas. He's the chief market strategist at Convergex, a global brokerage company based in New York. Hi, Nick.
Hello.
Hi. So, Wednesday's trading was a roller coaster ride, right? As investors waited for the Fed minutes and then to digest it. It was up and down, but not only are the markets looking for direction, it's very expensive right now. But you say the markets seem challenged to walk and chew gum at the same time. What do you mean by that?
Well, the tough thing the market's really facing right now is not only worrying about how to handicap the chance of the Fed raising rates, but also doing the fundamental work to understand which sectors and which stocks will do the best in different environments versus the worst. And the challenge they have right now is that they're trading basically all as one. Correlations among different sectors and different asset classes are still quite high.
Right, and high correlation means it's a stock picker's market, and you did manage to find some that that outperformed the S&P 500. Can you share with us some of those?
Yeah, even with correlations as high as they are, some 27 different names are up more than 20% on the year. And there are names I'm sure you've talked about before, names like Netflix and Kraft, some household names in there. So it's not impossible to beat the market, even with high correlations, but you do have to focus on really having big positions in the winners to really beat this very clustered market.
And if you can handle even more volatility, aside from the equity market, but from crude oil prices, is energy stocks something that people should look into for opportunities?
Yeah, it was really interesting. Energy stocks had the lowest correlation among any of the 10 sectors in the S&P last month. That's a very promising sign because it is working on the fundamentals of crude oil prices. They didn't do particularly well. They were flat on the month, but at least you are getting some diversification benefit from that. High yields, another area to look at, lower correlations and a lot of energy exposure as well.
And timing the markets is never a good idea, and nothing that either one of us are suggesting. But with Q1 earnings now underway, do you think investors should stay on the sidelines till the earnings season kind of settles, or just get in now before the action happens?
You got to really focus on, you got to pick your spot. So for example, the S&P is only up about 1.5% year to date. Mid-cap stocks are up closer to 5%. Small cap stocks are up 4 to 5%. Companies with less dollar exposure seem to be doing better. I'd focus on that as a big theme for Q1 earnings.
Great. Thanks so much for sharing your insight with us today, Nick.
Thank you.
Nick Colas is the chief market strategist at Convergex, and I'm Susanna Lee for The Street.